Look at this chart. Silver just hit $75 per ounce, and not in a nice, healthy, boring precious metal doing precious metal things kind of way, but in a someone just discovered Tesla is powered by silver, and Elon tweeted about it at 2 a.m. kind of way. Because here's the thing, over the last decade, silver averaged somewhere between $15 and $25 per ounce. Respectable, predictable, the kind of asset your grandfather would put in a safe and forget about. But in 2025 alone, silver surged 147%. That's not a typo. 147%. Which means if you bought silver at the start of 2025 for around $28, you're now sitting on $75 and probably questioning every financial decision you've ever made that didn't involve shiny metal. But don't worry, it gets even weirder. Because nobody can actually agree on why this is happening. Not traders, not economists. Not even that one finance Twitter account with 400,000 followers who's been predicting the silver squeeze since 2019 and is now acting like they called the whole thing. Let's start with the most overlooked part of this story. Silver isn't just a precious metal anymore. It's a core industrial commodity powering modern technology. Silver is the best electrical conductor of any metal at room temperature. Better than copper, better than gold. If you're building anything that moves electricity efficiently, you need silver. And right now, the world is building a lot of electrified infrastructure. In 2014, solar panels accounted for about 11% of global silver demand. By 2024, that jumped to 29%. The EU alone aims for 700 gigawatts of solar capacity by 2030, requiring roughly 250 million ounces of silver annually. Nearly a third of 2024's total global mine production of 819 million ounces. Even more interesting, newer high-efficiency panels can use up to 50% more silver than older designs. Electric vehicles are another major driver. Gas cars use around 15 to 25 grams of silver. EVs use 25 to 50 grams, sometimes more, across power electronics, battery systems, and charging infrastructure. By 2031, EVs are projected to account for 59% of automotive silver demand. Add AI data centers, 5G networks, and advanced electronics, and industrial silver demand reached a record 680+ million ounces in 2024, over half of total global demand. Here's where the math breaks down. Demand is surging, but supply isn't moving. Global silver production in 2024 was about 819.7 million ounces, up just 1% year over year. Zoom out further, and mine output has actually declined since 2010. Production is drifting backward while demand accelerates forward. Not exactly a stable equation. The real constraint? About 70% of silver is mined as a byproduct of copper, lead, zinc, and gold. That means output depends on demand for those metals, not silver itself. Even if silver prices spike, miners can't simply flip a switch and produce more. The Silver Institute projects a 149 million ounce supply deficit in 2025, the fifth straight year of shortages. Over the past 4 years, global demand has exceeded supply by roughly 700 million ounces, nearly 10 months of total mine output. And industrial silver doesn't come back. Once embedded in solar panels, EVs, or even electronics, it's effectively removed from the supply chain. Now, before we get into the part where central banks and sovereign wealth funds start buying silver like it's 1980 all over again, quick thing, hit that button and let's keep going, because this story gets way more interesting. Now here's a concept that precious metals people obsess over, called the gold to silver ratio. This measures how many ounces of silver it's going to take to buy 1 ounce of gold. Historically, this ratio averages somewhere between 60 to 80 over long periods. But in April 2025, the ratio was sitting above 100 to 1, meaning gold was extremely expensive relative to silver. Today, that ratio has crashed down to around 57 to 1, which is the lowest it's been in years. And that's significant because it suggests silver has been playing catch-up to gold this entire time. Gold went on its own record-breaking run in 2024 and 25. Silver just took a bit longer to wake up. But now that it's awake, it's moving faster than gold on a percentage basis. Gold is up about 67% in 2025, which is huge. But silver's 147% gain is more than double that. And historically, when silver starts outperforming gold, it doesn't stop gently. It goes into what traders call a mania phase, where prices decouple from fundamentals and start moving based purely on momentum and FOMO. Some analysts are now predicting silver could hit $100 per ounce in 2026. Bank of America sees it reaching $65. JP Morgan projects an average of about $81 for the year. And on the more aggressive end, some long-term forecasts are calling for $133 to $143 by 2030. Now, are these predictions going to be accurate? Who knows? But the fact that major banks are raising their silver targets mid-rally tells you they're seeing something structural, not just speculative froth. Here's the part that makes this different from previous silver rallies. Central banks, which have been buying gold by the ton for years, are starting to look at silver. Now, let's be clear. Central banks are not piling into silver the way they're piling into gold. But something shifted in 2024 and 25. Russia announced a multi-year plan to accumulate $535 million worth of silver for its reserves. That's the first time a major central bank has openly added silver to reserves in the modern era. India has also been quietly accumulating. And then Saudi Arabia made its first ever purchase of the SLV Silver ETF. Now this matters because even if a small fraction of central bank buying shifts from gold to silver, the market cannot absorb it. The entire global silver market capitalization recently hit about $4 trillion, which sounds massive until you realize that's roughly the size of Apple, one company. Gold, by comparison, is north of 18 trillion. So, silver is a much smaller, much thinner market. And when big institutional money shows up, prices move violently. Let's talk about the macro setup because this is where things get spicy for anyone holding bonds or cash. The Federal Reserve spent 2025 cutting interest rates. They started the year with rates in restrictive territory and brought them down to around 3.50 to 3.75% by December. Lower rates reduce the opportunity cost of holding non-yielding assets like silver and gold, which makes precious metals more attractive. But here's the kicker. Real yields, which are nominal interest rates minus inflation, have been hovering near zero or negative for most of 2025. That's the sweet spot for precious metals. Because when real yields are low, cash and bonds lose purchasing power in real terms, and hard assets like silver start looking like the smarter play. Add in the fact that the U.S. national debt is now pushing $36 trillion. Deficit spending is running at over $1.5 trillion per year, and the growing concern about the dollar's reserve currency status, and you get an environment where people start moving money into tangible assets. Not because they're panicking, but because they're hedging a future they don't fully trust. And silver, being cheaper per ounce than gold but still a monetary metal with 5,000 years of history, becomes an accessible hedge. It's gold's little brother that everyone can actually afford. What's happening in silver isn't one catalyst, it's 5 converging at once. First, industrial demand is exploding as solar panels, EVs, and AI infrastructure consume record amounts of silver. Second, supply is structurally constrained because roughly 70% of silver production comes as a byproduct of mining other metals, limiting rapid output growth. Third, 5 consecutive years of supply deficits have steadily drained global inventories. Fourth, central banks and sovereign wealth funds are beginning to diversify into silver. And fifth, a macro backdrop of low real yields and rising global debt is pushing investors toward hard assets. Any one of these factors could support higher prices. All 5 together help explain a 147% rally in a single year. With industrial demand projected to grow through 2030, and deficits expected to persist. This could be the middle phase of a multi-year bull market, not necessarily the end. Silver's move from $28 to $75 in a year is massive. But in markets like this, a 15 to 25% correction would be normal. Silver is smaller and more volatile than gold, so pullbacks can be sharp. Investors who FOMO in near the top often panic during corrections. Those who benefit typically understand the fundamentals and hold through volatility. If you're entering silver, do it because you understand the supply-demand dynamics and expect a roller coaster. That's where we are with silver. A metal ignored a year ago, now outperforming most major assets, backed by real structural demand. But this isn't a free money trade. Volatility is part of the game. If you want clear, no-hype breakdowns of economic shifts that actually impact your money, subscribe now. Don't just watch markets. Understand them. Drop your take on silver below, and we'll see you in the next one. This story's just getting started.